Before the financial crisis, average disposable incomes were growing by around 2% a year. But in the past 14 years, average incomes have stagnated. It's been the worst period for income growth since the Great Depression. If the pre-crisis trend had been maintained, average incomes would be nearly £14,000 higher than they are now. The problem is that economic growth has slowed down dramatically. And if we take into account the 8% rise in the population, real GDP per capita has increased at an even slower rate. To put it into context, per capita growth is significantly less than the 1970s, a period of economic instability and frequent crisis. Now, average incomes don't tell the full story. Benefits have been squeezed, causing the poorest fifth of the population to see falling incomes. The Resolution Foundation report that benefit cuts since 2010 have reduced the incomes of poorer households by around £3,000 a year. Now, there has been some good news for low-paid workers. The national living wage has risen faster than inflation, and this has increased wages of the lowest paid. But there's been little uprate for workers earning above the minimum wage, and we increasingly rely on the national living wage to do a lot of the heavy lifting in boosting wages. Pensioners have done relatively well due to the triple lock pension guarantee. Pensions have certainly grown faster than other benefits. But recent tax changes have started to claw some of this money back. The last budget was actually relatively progressive in that higher income earners and richer pensioners were paying more tax. But still, the UK poorest families are around 27% worse off than counterparts in France and Germany. And of course, it is true that the past 14 years have been difficult for many economies. Europe's economies have grown relatively slowly too. But if we look at wage growth, the UK is still one of the worst performers. And the result is, if we compare the UK to similar sized economies, the disposable income at purchasing power parity shows the UK is really fallen behind many of our other countries like Australia and Germany. Also, if you took London out of the equation, the rest of the UK is even worse off, because despite talks of levelling up, if anything, the regional inequality has increased in recent years and is set to keep getting worse. From the late 1980s to 2022, UK inflation had been fairly tame. The rise in inflation to 10% and its stubbornness has been quite a shock to the system. It was a major cause of falling real wages, and also it was a hit to business confidence. Although inflation is now coming down, many households will experience inflation in a different way, because basically, although the inflation rate is lower, the 20% rise in the price level is permanent. There was an interesting academic paper which stated that the reason we dislike inflation so much is we tend to blame inflation on policy failures, but attribute wage rises to our own hard work. Now, ironically, out of all the economic problems, inflation has probably least to do with government policy. It was a global supply-side shock and global phenomenon. Now, you might point to some of the failings of the Bank of England monetary policy, but that's another issue. However, it is worth pointing out that inflation was higher in the UK than, say, Europe, a consequence of a greater reliance on natural gas, but also higher Brexit transport and trade costs. Number 3, higher tax to GDP. In 2022, the Trust budget offered nearly £190 billion of unfunded tax cuts. It were tax cuts which were going to boost economic growth. But unfortunately, the budget was a bit of a disaster. Markets crashed and the government was forced into a U-turn, bringing in tax rises a few months later. It was one of the biggest U-turns on tax on record. The problem is that low economic growth and the demand for rising healthcare and benefits have caused upward pressure on tax to GDP, despite really every effort to avoid it. Now, recent tax cuts on national insurance will not stop overall tax rates rising to the highest level in peacetime. The problem is that despite these tax rises, public services are still falling behind. We'll see what happened to NHS waiting lists soon, but whether it's education, housing or justice, government spending in unprotected areas has been squeezed quite significantly. Also, out of interest, the government's recent commitment to increase spending to 2.5% of GDP, they claim an extra £75 billion, will definitely mean higher taxes or lower spending elsewhere. And here's an interesting graph that shows that only a few decades ago we spent more on defence than healthcare. And so much of the increase in healthcare as a share of GDP was financed by the peace dividend and falling defence spending. So if that goes into reverse, it'll be another pressure on government finances. Even though tax to GDP has gone up, it's not stopped a near doubling of debt to GDP in the past 13 years. Now, there have been a couple of economic shocks. COVID and the Ukraine war and of course the great financial crisis. And the government response to support during lockdown and energy price spikes was understandable. Higher debt is not necessarily a metric to judge government performance on. But still the overall picture is uncomfortable in that debt is trending up because the economy is struggling to grow and there's these increased benefit spending because of an ageing population. And also the recent inflation interest rate rises have increased the cost of debt interest payments quite significantly, over 120 billion last year. Now, in theory, debt is forecast to fall in 5 years' time. This is the government's fiscal rule. But no one really believes this will happen in the sense that government debt forecasts are quite easy to fudge. They're based on the promises of tax rises and spending cuts that are quite hard to actually materialise. So whilst there's no need to panic, the UK does face less room for manoeuvre when the next crisis almost inevitably hits. Productivity is the output per worker and is a key measure of the underlying economic performance. But since the great financial crisis, the post-war trend in productivity has fallen sharply. And this is the main reason behind all these problems of low wage growth, rising debt and rising taxes. Unless this can be improved, the UK's problems will continue. Now, OBR forecasts for the future are based on productivity growth of 1.5% a year, which is actually quite optimistic given recent years. And if productivity growth continues to be less than 1% a year, then the outlook for the future is even more grim than official forecasts. If stagnant wages was not bad enough, we also have a housing crisis on top of it. House price to income ratios reached a record level in 2022, nearly 9 times income. Now, in the past 12 months, real house prices have fallen by about 12-13%. But it hasn't really made it any easier to buy a house for first-time buyers. The slight improvement in price-to-income ratios have been offset by higher interest rates, higher mortgage payments, and the need to get a bigger deposit. The result is that first-time buyers face the worst set of affordability in 70 years. In 1997, the most common arrangement was for a young couple with children. Now, the most common arrangement for young people of the same age is living with your parents. So this cost of living crisis has really shifted the way we live. And it's not just buying a house, but also the private rented sector has seen really quite significant rent rises. Despite the cost of living crisis, rents rose over 6% last year. So both renters and first-time buyers have seen a bigger share of their income go on housing costs. And the result is that the UK is one of the most expensive places for housing in the developed world. Amidst all the doom and gloom, it's good to have at least one relatively good piece of information to share. Unemployment has fallen quite substantially, and it's much lower than the 80s and 90s, when unemployment was often averaging 10%. Now, some people make the point that government changed the way they calculated unemployment, and this is true for the claimant count method. But the main measure is the labour force survey, and its basic methodology has not changed. It's an international measure. And we can compare the two measures of unemployment, and at the moment they're relatively close to around 1.5 million. But what the unemployment rate doesn't show is economic inactivity. This is people not actively looking for work, but who leave the labour force due to sickness, early retirement, or looking after sick members of a family. Inactivity did fall in the early 2010s as the economy recovered a little bit from the recession, but in recent years has increased quite worryingly. And long-term sickness is a major cause of this higher economic inactivity. The fall in unemployment was one reason for the fall in income inequality in the early 2010s, but it's begun to worsen again in recent years. And it's worth bearing in mind that wealth inequality shows a different picture. Wealth inequality has tended to rise in recent years. NHS waiting lists have risen quite dramatically. Poor health is a major problem facing the UK. Waiting lists have increased sharply, COVID was a major stress to the health system, with hospitals squeezed beyond its capacity, but also there's been a growth in long-term sickness and difficulty getting an appointment with a doctor. Despite higher real spending, as a share of GDP, healthcare actually tailed off a little bit in the early 2010s, bucking international trends. And this relative squeeze in health spending was a factor in building up some problems which really exploded during COVID. Now, it is hard to make accurate comparisons with waiting lists in the past because methodology changed. But waiting lists did fall during the last government, primarily because so much extra money was spent. But in recent years, waiting lists have definitely risen. Since 2016, trade in goods has fallen for the UK, especially to the European Union. Services are largely unaffected because they aren't affected by the same Brexit tariffs and customs which have come in since the Brexit deal. As a result, trade in goods has grown slower than many of our main competitors. We can see how the UK has seen a decline in trade openness. This is how easy it is to trade with other countries, and it's a reflection of the new trading barriers post-Brexit. Net migration has been an important economic and political issue. High levels of EU migration were a factor behind the Brexit vote of 2016. However, with many firms experiencing labour shortages, the post-Brexit migration policy actually led to a surge in migration. One factor behind this was that non-EU migrants who come from further afield tend to want to bring their families too. Another factor is that the UK has seen many real shortages of labour in key areas like the healthcare and care workers. And also, there's been a decline in the labour participation. This links back to the poor health of the workforce. You could also add low productivity growth, which is meaning that firms need more workers rather than investing in capital. Now, net migration has both pros and cons. It's definitely put pressure on the housing market, with the number of households rising faster than supply. And the UK has a real difficulty in meeting government targets of building houses. On the other hand, net migration tends to help government finances, at least in the short term, because migrants tend to be of young working age, paying tax but not claiming pensions. So these are some of the basic facts of the past 14 years. And a lot of grim economic reading there, not great. And I haven't got time to go into all the reasons why these economic data has behaved like it has. This video goes into more detail in why these trends have occurred and what's likely to happen in the future.